All right, welcome everyone. This is the second part of this webinar series, Not All Indexes Are Created Equal, presented by IDX and FactorE. My name is Andrew Swan. I'm the CEO of IDX, and I'm joined today by my partner Ben McMillan, the founder of IDX and CIO, as well as John Belanger, the CTO of FactorE and AlphaCore Technologies. IDX is an investment research firm that was founded on the principles of combining academic research and empirical insights to deliver best-in-class solutions for institutional investors and wealth managers alike. FactorE is a platform that brings institutional quality analytics to financial professionals, and their multidimensional risk engine uses machine learning techniques to deconstruct portfolio risks, show factor exposures of assets and accounts, and offers real-time feedback as users look through history to see risk factors and how they've changed over time. Now, before we dive in, it is requisite that I state the obligatory disclosures.
This webinar has been provided to you solely for informational purposes and does not constitute an offer or solicitation of an offer or any advice or recommendation regarding the purchase of any securities or other financial instruments and may not be construed as such. The factual information set forth herein has been obtained and derived from sources believed by IDX advisors to be reliable, but is not necessarily all-inclusive and is not guaranteed as the accuracy or does not to be regarded as a representation or warranty, express or implied, as to the information's accuracy or completeness. This document is intended exclusively for use by financial professionals to whom it's been delivered by IDX, and is not to be reproduced or redistributed to any other person. All information herein is impersonal and is not tailored to the needs of any person, entity, or group of persons. The investment themes discussed herein may not be suitable for investors depending on their specific investment objective and financial situation. Forward-looking statements contained herein are not guarantees of future results. Charts and graphs provided herein are for illustrative purposes only. The information contained herein may contain hypothetical performance data. Hypothetical or model performance results have certain limitations. For example, hypothetical results do not take into account actual trading and market factors, such as liquidity disruptions. Simulated performance is designed with the benefit of hindsight, and there can be no assurance that the strategy presented would have been able to achieve the results shown. There are frequently large differences between hypothetical performance results and actual results from any investment strategy. Also, index returns do not reflect payment of certain sales charges or fees an investor may pay to purchase the securities underlying the index or investment vehicles intended to track the performance of the index. Exposure to an asset class or trading strategy or other category represented by an IDX index is available only through third-party investable instruments, if any, based on that index. IDX does not recommend, endorse, approve, or otherwise express any opinion regarding any issuer, securities, financial products, or instruments, or trading strategies. Nothing contained herein constitutes investment, legal, tax, or other advice, nor is anything herein to be relied on in making an investment or other decision. There can be no assurance that an investment strategy will be successful. Historic market trends are not reliable indicators of actual future market behavior or future performance of any particular investment, which may differ materially and should not be relied upon as such. IDX provides links to third-party websites contained herein only as convenience, and the inclusion of such links do not imply any endorsement, approval, investigation, verification, or monitoring by us of any content or information contained within or accessible from the linked sites. If you choose to visit the linked sites, you do so at your own risk, and you'll be subject to such sites' terms and use of privacy policies over which IDX has no control.
Well, let's not waste any more time. Let's talk about what we're going to go through today with our agenda. First, I'm going to have John Belanger tell us a little bit more about FactorE, and then he's going to give us a demo of their risk analytics platform live. Then we're going to get into the benefits and the drawbacks of indexing, index construction methodology and why it matters, a few things to think about in the due diligence process, some of the best practices that IDX has come across in our experience over the last decade, and then we'll wrap up with a real-life case study. So without further ado, John, we're very excited to have you and the FactorE team join us. We're excited about what you guys have built and what it means to the financial services industry. So take a little bit of time and tell our listeners today, what is FactorE and what are you delivering to the market?
Yeah, thanks, Andrew. It's good to be here and appreciate you having us on. FactorE is it says here, a portfolio communications platform. And really at the heart of FactorE is risk analytics. But we use risk analytics to help empower investment professionals like investment advisors and like asset managers to have personalized discussions about investment solutions. And the personalized is important because whereas many clients can appreciate a risk score, a number, sometimes they can relate to it, other times they cannot. Sometimes they want to dig deeper, right? And even if you think about financial advisors and the conversations that they want to have with their colleagues and with folks in the asset management industry, they want to really understand what is driving the returns for their clients. They want to be the experts for their clients. So FactorE at its heart is a risk analytics platform, but really what we try to do is enable our users to have effective discussions about risk. And what's interesting, Andrew, is I came from the wealth manager side of the business. I managed model portfolios, and I actually came from the alternatives space. And this is not a tool specifically for alternatives, but one of the things that I think alternatives got right early on was they said, I am not going to get paid 2 and 20 to deliver equity beta. They did it for a while, but there came a time where they said, no, I need to deliver something in addition to equity beta. So they started to look for other sources of returns. And the academics caught on, and they began to test those assumptions. And so really it was the world of alternatives that brought factor investing into the mainstream. And now we don't all have to use that technique to invest, but no matter what we do, we're going to have exposure to factors. And so, we hope that FactorE helps to unearth some of those factors that are in our portfolios.
Well, that's a great insight because, that's exactly where we got our start. It was in hedge fund replication, which ultimately generated the insights that many of the best insights put to practice by active managers could systematically be replicated in what we now know as factors, like you mentioned. And we were super excited about FactorE because you guys ultimately gave us the ability to better illustrate what it meant when we talked about a factor relative to a market cap weighted index or some other competitive index.
Well, it's so true, Andrew, because there are times when you look at a fact sheet and you see a Sharpe ratio, and that's really what you have to compare, right? Okay, I'm going to compare Sharpe, I'm going to compare Sortino, I'm going to compare upside, downside against a benchmark. Now, don't get me wrong, those are helpful statistics, right? And we'll dive into the platform in just a minute. I think we're going to do a short demo, but those are helpful statistics. It's good to know what a Sharpe ratio is and how it compares to its peers. But are you missing something, right? Is it really telling the whole story? And especially for folks who are focused on building multi-asset portfolios, right? If I've got a portfolio with stocks and bonds and maybe real estate or alternatives, I want to understand where the intersection of those different asset classes exist. And if I have overlapping factors, right, this is great. Many solutions don't fit inside a style box. Not everything is large cap value, large cap growth. And if you go to the next slide, you'll see that maybe if you use a different lens, you can look at smart beta, factor-based asset, multi-asset, or you look at these things a little bit differently, hopefully bring some clarity. And this last slide, I think, is an interesting one because, what you have here is, there's actually a lot going on this slide, so I'll take it slowly. But on the left-hand side is what we call a factor radar. It's got 15 different risk factors, and there are 2 assets being mapped there. One asset is a blue line, and the other asset's a green line. That black dotted circle is the 0 line. And as the dots go further out, the betas to those risk factors get higher. And as the dots are further in, they turn 0 and then eventually negative. And so you'll notice what we highlighted on the right are those factors. It's the same data, just shown differently. Those factor betas on the right, you can see those major differences between the real estate factor and emerging markets. And, one of the nice things about sort of being human is that we tend to see shapes quite well, right? And we recognize these things very, very quickly. So our eyes will get drawn to those differences on the left-hand side faster than they'll get drawn to the differences on the right-hand side. And so we use easier to understand visualizations to help showcase some of those differences.
Yeah, John, this is something that you and I have talked about at great lengths because being able to visually see and differentiate between investment exposures and factors and various strategies is going to be very key as we get into the next phase of the direct indexing revolution. And I understand that you have a demo set up for us to actually show people live what it is your technology does with exposures, different analytics, as well as being able to run portfolios in real time. So I'll let you take the reins.
Thanks, Andrew. I'm going to take us for a quick tour inside of FactorE. You'll notice the address is myfactore.com. And when you log in or sign up in the top right, by the way, users can sign up and try the software free for 30 days. You can upload portfolios. We're synced with a number of different portfolio aggregation services, so it's a pretty easy import. But in any case, I'm here at the home screen, and I thought I might just very quickly run through a portfolio analysis, and then actually I'm going to bring up that analysis that I was showing earlier on one of those slides. So first here, I'm going to go to portfolios. I'm going to search for portfolios, and let's take this portfolio here that one of my colleagues has shared with me. Looks like it is a, don't worry, there's a fake Smith retirement and family trust. It's $1 million portfolio, and I've clicked analyze. Now here I am in the analysis dashboard, where I can get a sense of the portfolio's makeup in terms of, you can see it's 60% equities, 25% or so fixed income, and, or excuse me, 30% fixed income, and then another 5% allocation. But what's interesting here, right? So I've got 62% in equities, but 91% of the risk, right, of the volatility in the portfolio is coming from equities. So this is a little bit different in that, you know, we can look at our portfolio one way, a cash weight, or we could look at a vol weighting. And in fact, if you were to talk to quantitative managers, hedge fund managers, a lot of them look at their multi-asset books in this way. Right? This is how a lot of the very large multi-manager hedge fund of funds think about things. So here I've got all my holdings on the left. Really quickly, I'm just going to group by account, and I could analyze an individual account, and you'll see I'll actually be able to analyze an individual asset as well. So we've got this infamous factor radar, which I spoke about a little bit earlier. You can see that zero line here, and the spiky, you know, it's a 0.72 beta to equities, right? I can also look at that with a bar chart if I want to understand this in maybe a more familiar chart format, right? And actually one of the nice things about the bar is I'm actually going to click on equity here, and now I can actually see what's driving my equity exposure. So this allows me to start really drilling into what is actually driving the risk in my portfolio, right? When I understand what's driving the risk, right? When I understand which factors are exposed in my portfolio, right? It's not a bad thing or a good thing, but once I understand that, then I can actually get a sense of how that portfolio might perform under different circumstances. So I've got $1 million portfolio. I'm going to look at this in terms of dollars instead of percent, but I've got $1 million portfolio, and you can see in the tech rec, given this factor exposure, this portfolio would have lost $281,000. That might be okay. I might be just fine with that, but it's good to know. Right? And in fact, if I don't want to look at just a sliver in time, but I want to look much further back, we allow you to do that with this growth of 1,000. This can actually be really powerful, where you'll notice that these numbers will change as I drag this bar along, right? But what I can see here is this is my portfolio. This is kind of a fixed weight, right, of all of these holdings, this green line. But it stops in December of 2010. And the reason it stops in 2010 is because one of these assets has an inception date of 2010. It might be double line. But in any case, in December of 2010, that's when I've got my shared inception date, the common inception date for the portfolio. But sometimes I want to go further back than that, right? And that's what we allow our users to do with this factor-based analysis. So I can represent the portfolio using factors, and this is what most institutional, analytics programs use, is they'll use something, whether it's Barra or Bloomberg or something, they'll use the underlying risk factors and project returns using those risk factors. And that's exactly what we do here. And we actually are very transparent about how good or bad of a job the analysis engine does at representing the portfolio. So we're by no means is FactorE ever going to tell you, yep, we've got 100% of this risk nailed down. We know every single thing. That's probably impossible, but we can get a really good idea, and that can help us to understand how a portfolio might perform. Now, I'll pause here for 1 second, and there are a lot of other little rabbit holes you can go down, and we have folks who are happy to give a demo if somebody wants a walkthrough. We're happy to do that for you. You can sign up for a demo actually by clicking right here on our intercom. But I just want to run a quick comparison now, where let's take that same portfolio, right? And I think I had Connor's, and I think Connor also gave me one of these guys. So let's take a comparison between that original portfolio, right? Smith Retirement and Smith Family Trust. And he's actually grouped these portfolios differently. So some folks will actually group it by account type. For model management folks, right, for analysts, PMs that are running models, folks will sometimes group using asset class. And so that's what he's done here, right? So now I can actually see these two portfolios side by side, or actually on top of one another. And you can see this current, right, this spiky 0.72 beta to equity relative to half that, 0.36 in this proposed portfolio. So I can see that I have a less spiky factor radar, right? And I can go down and look and see, oh yeah, look, this doesn't do as poorly during these drawdowns. It doesn't do as well during the rebound, but maybe that's something that I'm more comfortable with. Oh, and by the way, I can look to see how these portfolios would have done over time, right? Both on a factor-based basis and real. So we've got that flexibility, and it sometimes can be very helpful to understand comparing portfolios to one another. And so not only can you compare portfolios with one another, but you can also compare accounts and assets with one another. And in fact, what we've done just before this webinar is uploaded a private asset that is representative of an index. So if I type in IDX here, you'll see we created this IDX large multi-factor defensive index. So this is not investable, and all disclaimers apply, but we have just a monthly return stream that goes back here. And so if I have a monthly return stream for a hedge fund or for anything, in this case we're using an index, right? And we're going to compare this index against another asset. So here we go. I'm going to just pop in here and got this IDX index, and why don't we do another another defensive. Actually, this is not multi-factor defensive. This is low volatility strictly. So we're going to compare these two assets with one another. And you'll notice probably right away that the factor radars look very similar. And the major differences being, one, it looks like this the SPLV is more heavily weighted to large cap, but along the top here you can see that carry, which is FX carry, so currency carry, and duration, so interest rate risk, right, is present in the in the blue line here in the IDX index. So I would wager a guess that, and this is without knowing performance, I'd wager a guess that the duration probably helped this index last week during the coronavirus. What do we want to call that? That massive drop in the equity markets. So in any case, here is an example of looking at two similar strategies, trying to understand how do I compare these two strategies? How do I make heads or tails of these two strategies? Well, now I have a talk track. I can understand why these two strategies might be different, or how they might be different. And so if I understand how these two strategies might be different, I can form an opinion, right? This FactorE does not have an opinion about which is better. But what it can do is it can say, okay, given those factors and given those exposures, here is how this would have done. It maybe would have done a little bit better during the tech wreck and the financial crisis, but not as well, potentially not as well during the equity markets rebound, right? And you can see over time how one strategy does against another. So again, taking this concept of factor-based investing, right, and applying it to portfolio analytics and to risk analytics so we can understand what are the actual drivers of returns, even if I'm not investing for value or if I'm not investing for defensive. I can still understand what the drivers are of my returns and how these returns might show up in various situations.
You know, John, one other thing that might be pretty cool for the audience listening in today would be to show this graphic of, say, the IDX large cap multi-factor defensive, which is an index that we created, which is a bit more sophisticated interpretation of low volatility. It also factors in not only price volatility, but beta volatility, as well as implied volatility in the options markets. If you could show the graphical representation that you have right here with the factor analysis of that index against, say, SPY or just, you know, the broad S&P 500 index, so they can see when you compare that, you know, against another asset, what does that look like if it's not as similar?
Sure. Let's do that real quick here. All right. So what I've pulled up here is, you'll notice the blue is this the IDX large cap multi-factor defensive, and the green is SPY, right? So you'll notice that SPY pulls much more strongly to the US dollar. It pulls much more strongly, so about a 0.4 beta difference between SPY and the IDX defensive index. Finally, probably no surprise, defensive is the largest overweight, if you will, in terms of risk exposures, followed by real estate. So certainly interesting to see these kind of overlaid on top of each other. What do you think, Andrew?
Well, I think it's why we're so excited about this, because it's not easy to understand the differences of indexes and index methodology, and that's, of course, why we're having this webinar today. But what you guys have built makes it very simple to show the differences and commonalities between different asset classes and strategies alike. And you can clearly see from the comparison on the previous analysis with, you know, SPLV, which is the low vol version of the S&P 500, right? There's more overlap, although you can see even in those similarities, there are differences between our index and that strategy, and it's helpful to know where that risk is coming from. And when you compare it to the S&P 500 via SPY, right, you can very clearly see that there are massive differences in the risk associated between these two strategies, as seen by equity beta, dollar risk, and everything else that you pointed out. So we love it because it makes it very easy for our clients who are institutional investors and wealth managers to understand the differences between our strategies and other strategies in the marketplace, but also be able to tell that story to their clients as well.
That's great. And, you know, the last thing I'll mention before wrapping up and turning this over is, you know, one of the great things about FactorE is this actually allows me to build this inside of a portfolio, right? So if I go back to this proposed portfolio that was created, right, I could save this as proposed with IDX, and I'll save that. And so now I've got this new portfolio that I've created. I'm going to pull out, I've got, what do you know? All right, so I've got SPLV. I'm going to replace that, right, with IDX, and, you know, maybe even keep this the same. But now I can actually look at these portfolios side by side. Why don't I go current? And I had the prospect current, and then I had proposal. Actually, I think I renamed it. There it is, proposed with IDX. So now I'm looking at, again, going back to this, right? Now I've got this IDX with monthly returns right in there, and I can compare portfolios with one another using these private assets. So it's a great way if you ever want to understand how these maybe unique assets fit into a portfolio and are different or similar to some of the assets that we might know and use.
Yeah, that's fantastic. For everyone listening and wanting to have a conversation further with John and his team, stay tuned. At the end of this presentation, we'll provide their contact information, or you can visit them at myfactorE.com. All right, so let's talk about the rise of indexing and the benefits that come along with it. Ben, tell us about the power of indexing from your perspective and what ultimately drew you to doing the research and spending your career in the industry starting well over a decade ago.
Well, what originally drew me to this side of the industry actually started early in my career when I was at a fund of funds running regressions all day decomposing active hedge fund manager returns. And what we saw, which was entirely consistent with all the academic literature on the subject, was that active managers' returns could by and large be pretty easily explained by various known risk premia. There really was no secret sauce behind the scenes, so to speak. And so the reality is that within any active manager, you've got two competing forces. The so-called left brain, which is the critical thinking, rational decision maker, and then the right brain, which is the greed, fear-driven animal spirits, as they say. And the reality is that the active managers can't turn off this right brain, and it inevitably leads to poor decision making over time. So the appeal of indexing is just simply the ability to isolate this left brain and all its qualities while avoiding all the problems and the behavioral biases that come with the right brain decision making. So the work that was done on that ultimately led us to write a paper on this subject as well as develop a hedge fund replication index that became a liquid investable benchmark for a number of our institutional clients. This pretty quickly grew to be a 9-figure mandate, and what we observed in running this was an interesting phenomenon which became the subject of this paper in 2014. Specifically, what we found was that the hedge fund replication index, the so-called clone portfolio, was able to track the returns of the active hedge funds themselves with a very high R-squared on a real-time out-of-sample basis, except with the only deviations coming during periods of stress or volatility spikes, most notably in 2011, when the active hedge funds underperformed the clone index to the tune of 6 to 7%. So this was interesting in that it provided evidence of the true robust negative alpha associated with the right brain and therefore discretionary management. This is the chart that everyone has seen before, but it's one that nicely illustrates one of the key benefits of indexing, which is the ability for investors to access the full spectrum of risk premia that were previously classified as quote-unquote pure alpha. This has led to the proliferation we've seen in the smart beta ETF landscape and what has now given rise to direct indexing, which of course has the added benefit of increased customization as well as tax optimization.
That's great, Ben. Thanks. So in summary, the power of indexing can be found in 1, removing behavioral biases from the equation, 2, systematically accessing exposures once held as the alpha-generating insights of active management, and 3, the ability to intelligently tailor an investment portfolio through better index logic, specific customizations, and tax efficiency, as you mentioned, in direct indexing. Now let's talk about some of the drawbacks that are found in the world of indexing. Ben, what are some of the things investors should be aware of when it comes to indexing?
So by design, indices are transparent and rules-based. A large part of the exercise in creating an index is to ensure that it's not just rules-based, but also repeatable, specifically meaning robust. So one of the issues in the last decade has been the explosion of indices, and therefore ETFs, beyond what's been justified by the research. We've all seen the increasingly niche ETF exposures that have come to market, as well as those that are driven by increasingly more complexity. And while in general this has been a very democratizing force for investors, more is not categorically better. The issue with too many factors is that some of them invariably end up being the result of data mining, which obviously negatively impacts investors because expectations don't line up with reality. We believe this is the biggest issue facing the indexing space currently. So to further this point of more factors than can be justified by the research was actually a speech given by economist John Cochrane back in 2011 in which he referenced the quote-unquote zoo of new factors. What's interesting about this speech was that he gave it almost a decade ago, so the zoo has only gotten more crowded since then. This is a closer look at the number of research papers shown by the red bars relative to the number of quote-unquote new factors that they've supposedly uncovered, shown in blue. You'll notice this trend also coincides with the rise in availability of both cheap data as well as cheap computing power, and reminds us, therefore, of the old question: if you had an infinite amount of monkeys pounding away on an infinite amount of typewriters, what is the probability that one of them would have come up with Shakespeare's Hamlet? The answer is 100%, meaning with enough data you can always find the answer you're looking for, which in our world is the risk of curve fitting. In what has become a now famous research paper, David Leanweber of Caltech actually goes through the exercise of data mining the S&P 500 by showing different explanatory variables with spurious correlations to the S&P 500 index. In his first example, he shows that over a 10-year period, butter production in Bangladesh actually demonstrates a 75% R-squared to S&P 500 returns. On this slide, he shows that by adding both U.S. cheese production and sheep population, he's able to get a near-perfect correlation to the S&P 500. Now, this is obviously an extreme example of spurious correlations, and it's easy to say that nobody in their right mind would actually try and use Bangladeshi butter production to trade the stock market. But remember, the behavioral biases of the right brain are powerful, and as evidence to that fact, to this day, Professor Leanweber still gets voicemails asking about the butter production figures for Bangladesh. Now just imagine if the relationship between variables isn't as clear-cut. It could be very easy, especially with an ability to quickly run hundreds of thousands of iterations, to stumble upon a rule set which looks like it would have performed great historically, but falls apart on a go-forward basis. Now, we want to be clear in the fact that backtesting isn't categorically a bad thing. There's a distinction to be made between backtesting and data mining or curve fitting. Specifically, backtesting is when you use computing power and data to analyze how certain rules would have performed in the past. The key is that the rules being tested came before the testing. Where this becomes dangerous and turns into data mining is when you start with a bunch of computing power and historical data, and you use that to create the rules, which by the very process is not robust, but will almost always look great in a backtest. This is why you hear people say, "I've never seen a backtest I didn't like."
Yeah, that's a super helpful insight for our listeners. And as quants, we field questions about curve fitting all the time, and it's important because it plays a major role in responsible indexing. But it's not the only thing. Ben, as someone who's created and built robust index methodologies for over a decade, tell us a little bit more about what goes into index construction methodology, and even how in the responsible world of indexing, you can get very large dispersions based on the interpretation of rule sets or the implementation.
That's an excellent question because it's not about just avoiding the pitfalls of data mining. It's now equally as important to understand the actual methodology behind a particular index or set of indices, even if they're ostensibly the same. So the graph on this slide is from a Vanguard paper which shows the returns for the calendar year 2017 for different value factor indices. And what's interesting, as you can see, is that value, quote unquote, can perform very differently depending on how it's defined and constructed. So things like number of constituents, how they're weighted, what the rebalancing frequency is, the number and type of value metrics considered, i.e. are they looking at price to earnings, price to book, both? All these things impact the type of value exposure that the investor is getting at the end of the day. Now, some of these may be considered better or worse implementations, but the key point to be made is that they each have to be carefully considered before choosing the appropriate implementation, because they're all robust, but they're not all appropriate for the type of value that people are necessarily looking for. So in order to provide a framework for thinking about responsible index construction, we borrow a well-known function from economics known as the Laffer curve. Specifically, we like to think about the maximum utility of an index as lying somewhere between too many rules and too few. This sounds overly simple and vague, and to some degree it is, because the actual curve is going to look different for every investor. The point to be made is that a suitable level of complexity for one might be overly complex for another, and with too few rules, the index just simply may not be useful enough. We believe, for example, some of the value indices that we just showed in the earlier slide were overly simple implementations that may be robust but not terribly compelling on a risk-return basis going forward. A final point to make about this graph is that it doesn't take into account the confidence interval around an index, which only increases as the number of rules increases. And we'll be diving into that in the next slide. So this is actually a live example of an index audit we performed for a large institutional investor on a third-party index, which currently has billions of dollars tracking it. This index trades only the S&P sector ETFs and only has two rules. It selects the top 5 sectors according to a single metric of value, and then from those, it selects the top 4 sectors according to a single metric of momentum. We show that as the quote-unquote baseline 5.4 portfolio that you see in the risk-return space above. The obvious question, of course, is what happens if you change one of those parameters? So as part of our responsible indexing, we actually went through this exercise where we backtested different iterations of this index using the same rule set, but just tweaking the parameters a little bit. And what we got was a very interesting distribution of outcomes. And this is the confidence interval I was referring to. So you'll notice that even a seemingly slight change to the number of S&P sector ETFs that were chosen in either the value or the momentum phases can have profound impacts on how the index historically performed. So specifically, when we look at the cluster of dots above, the number on the left within the parentheses represents the number of SPDR sector ETFs that were chosen in the first filter, which is the value filter. The number on the right represents the final number chosen as selected according to the momentum filter. So if you look at the very top dot, 4.3, that says that we selected 4 of the SPDR sector ETFs according to value, and then of those, we filtered out 1, leaving only 3 in the momentum phase. So not a terribly different result from the original baseline index where we chose 5 according to value and 4 according to momentum, but you see a little bit different result historically. Most interestingly, if you look at the very bottom dot, the 7.4, which is allowing 7 to pass in the first phase, the value phase, and then keeping only 4 according to momentum, it's not conceptually very different than the original baseline index, yet performs on average 3% worse per annum over this entire period. So remember, this baseline 5.4 index is the one that's live in the marketplace with billions of dollars tracking it real time. And you'll also notice that it's on the very upper end of the feasible return frontier. And so when we build and publish indices, we generally are wary anytime we have a final outcome or of selecting a final outcome that's this far away from the rest of the cluster. For the very simple reason that anytime you optimize on something like return, you're inviting fragility out of sample. Now to be clear, this doesn't necessarily mean this index was data mined ex ante. What we're saying, however, is that it's important to be aware of the confidence interval in this distribution of outcomes going forward if you're considering this index for investment.
So Ben, let's keep building on this topic of responsible indexing because I don't know if there's ever enough education we can provide to the space that will arm investors and wealth managers with the appropriate questions for due diligence. But there's generally 4 that we usually give to our clients when they're doing due diligence, and they go in this order. 1 would be, would you invest in the index without ever seeing a backtest? That means, is it logical? Or is this something that's drawn off spurious correlations like the Bangladesh Butter Index? 2, are the principles backed by third-party research? Is this something that one shop came up with, they ran an algorithm and had a great backtest? Or is this something that's been proven out over time in various geographies and asset classes, is well published in academia, as well as being known for working empirically in the markets? 3 and 4 run a similar line of logic, but 3 has every combination been tested. And that goes back to the slides we just talked about, where you've got to stress test all the different permutations of a model. And number 4 is what happens if you change one rule, right? If during that stress testing you start changing rules and the dispersion becomes rather large, that tells you that there's a lot of fragility in the model set or the data set, and that doesn't line up with what IDX defines as robust. So Ben, maybe you can take this a step further and provide a little more color or some examples for each one of these questions.
Yeah, so this is actually a perfect example of that. What we're looking at here is a very simple strategy that only looks at the ticker symbol of stocks. And specifically, it goes long those stocks that has an S as the third letter in the ticker symbol and shorts those with a U as the third letter. And so you look at this equity curve and it looks phenomenal on a backtested basis. Of course, it fails the first principle of responsible indexing, which is, would you ever invest in this strategy without seeing a backtest? And the simple answer is no, because it has no justification economically. So to answer the next 2 questions, are the principles backed by third-party research and has every combination been tested? We actually look at one of our own examples. In this case, this is our multi-factor enhanced value index, in which we're combining elements of volatility with the value factor to create a result. Now, it's important to note that the definitions in this case of volatility and value are backed by third-party research. These aren't our own definitions. This isn't part of the factor zoo that we came up with ourselves. And what we're looking at in the cluster of dots is testing every combination of those two factors. And what we like to see here is a consistency of outcomes, which is what we're observing. This is evidence that the integration effect we're observing or testing is not an artifact of the data. It's in fact a robust indication that the index was responsibly created. So to explain our fourth and final guideline, what happens if you change one rule, we look at another analysis we did for a third-party index provider, which in this case utilized a moving average crossover strategy. So consistent with our best practices, we went through the exercise of actually creating an outcome for every single combination of the fast and the slow moving average. In this case, what we're looking at is a similar distribution of outcomes associated with the different combinations of moving averages, but we're looking at the historical Sharpe ratio on the z-axis with the two lengths of the moving averages on the x and y. This parameter topology, as we call it, is an extremely useful exercise to understand how fragile or robust an index might be on a go-forward basis. So in simple terms, what we're looking at when we look at this graph is actually a cluster of different indices. Each dot in this graph represents a different index with a different Sharpe ratio. So in this case, the red means the Sharpe ratio is higher. These outcomes performed better historically. The green means the Sharpe ratio was lower. It was a worse trade-off from a risk-return standpoint. So what we like to see is, first of all, to just understand what the peaks versus valleys are for this outcome. This is part of the robustness exercise. How fragile is this outcome going forward, potentially? And generally, we want to see not a huge difference between the colors or the peaks versus troughs. So when we look at this parameter topology, the result of our findings is that it's actually fairly well distributed. You don't see any huge peaks or huge troughs. The maximum to minimum is really only about 0.5 on a Sharpe ratio scale, which if you look at different parameter combinations for different models, you can see orders of magnitude difference between the highest point and the lowest. So this is actually evidence of what we would expect to be a fairly robust index specification going forward.
Thanks, Ben. Those are powerful insights. When it comes to becoming an expert in anything, the fundamentals are key. But it's also usually quite useful to have real-life examples on how those fundamentals get put to work. So Ben, let's talk about a case study of a particular client account where we created a custom index implementation to meet a client's objectives and what went into that process. Because a lot of the logic and fundamentals, they sound simple, but maintaining and building custom indexes is actually quite involved. So the overview of this case study is a wealth manager who had a lot of high net worth accounts, and those accounts were using an ETF to track a well-known parent index. And this wealth manager wanted to know if they went the route of direct indexing, creating the ability to customize and tax manage and ultimately yield a better outcome for his taxable clients, could an index be created that still tracked this parent index but did so with far fewer constituents than the ETF was using? And Ben, I'll let you take it from here.
So in this case, when the objective function of the mandate is to statistically replicate a so-called parent index, we start with the data. So we buy data off the shelf from large data vendors to ensure robustness and quality. We then spend a non-trivial amount of time manually quality assuring that, ensuring that things like corporate actions are taken into account, survivorship bias is not an issue. And then we manually recreate different eligibility criteria to best reflect the parent index, such as liquidity, market cap, and sector. The result in this case is a universe of roughly 300 constituents with which we use to start the beginning of the index replication exercise. So the next step of this process is to actually create and backtest dozens of different indices, in this case roughly 75, that each employ a slightly different optimization function or different parameters such as final constituent count, look back, etc. This ensures that we have both a robust and comprehensive review of the distribution of outcomes as we've discussed, but also that we have different versions against which to stress test the final iteration. Now, because this is a goodness of fit exercise, each of the 75 models that we're looking at fall into some category of goodness of fit, as defined by the ordinary's least squares regression shown on this page. So specifically what we're looking at are those models that are purely optimized for R squared, those models that are purely optimized for beta relative to the parent index, and then those models that consider both goodness of fit metrics, R squared and beta, what we call the combo optimized. Further, for each class of those models, we we create different versions that consider different look-back periods and different optimization periods. For example, trailing 6, 12, and 24 months. Not only individually, but also as well as together. That's how we get to 75 models that consider different iterations, different combinations of the parameters in a robust, comprehensive framework that is our parameter topology, which can be seen on the table on this page. Now, it's important to note as a practical matter that on an ongoing basis, we actually maintain each of these indices on a go-forward out-of-sample basis in addition to the final index as a form of ensuring goodness of fit out of sample and robust stress testing of the live index relative to each of its counterparts. As can be seen in the result on this page, we were able to generate a clone index with a 94% R-squared to the parent index that ensured that the client was able to meet their primary objective while also allowing them to do so in a direct indexing format with 75% fewer constituents.
Yeah, Ben, and this was just the first exercise we did for this particular client, helping them to replace one of their ETF exposures with direct indexing. But they and their clients were so empowered by what they could do with direct indexing that in the last year, we've actually gone through their entire equity portfolio, replacing all of their ETFs with direct indexes across U.S. large cap, U.S. mid cap, U.S. small cap, and even international exposures via ADRs. And it just so happens that this is one of the fastest growing RIAs in the entire country, and they're scaling through their messaging and their outreach to clients, which is on the basis of tax alpha and direct indexing. Well, that wraps the presentation segment of this webinar. So we're now going to get ready to kick into Q&A. But I want to thank both Ben McMillan and John Belanger for joining us today and providing their insights. I hope everyone who dialed in found it useful and informative. And if you have any follow-up questions or want to talk more with IDX about direct indexing, please reach out directly to Ben Jacobson, the President and Head of Investor Relations. You'll see his email and phone number here. And if you want to talk to FactorE more about their risk analytics and the tools they can provide for wealth managers and asset managers alike, reach out to Connor Rude, the Vice President of Business Development, and you'll also find his email and phone number on this page.